it takes us to our talk of the tape. What it will take to keep stocks moving even higher from here. Let's ask Fundstrat's managing partner and head of research, Tom Lee. He is with us live today. Tom, welcome back.
Thank you, Scott. Good to see you.
Yeah, you too. This is a remarkable market. What is driving this, and what is driving this continued acceleration as we hit this final stretch today?
Scott, I think 2024 is revealing the stock market is getting stronger because it is proving to be extremely resilient. You know, last week Tesla missed, fell 11%. The S&P was up for the week. This week we had two big fangs miss and disappoint, and the market's, of course, roaring as we end the week. It's the 14th consecutive week. I think it has a lot to do with, one, the economy's incredibly resilient. The Fed, I think, has turned dovish. We don't know the timing of the first cut. Inflation, I think, is falling basically like a rock. And we know there's a lot of cash on the sidelines because there's over $6 trillion sitting in money markets. And yet the S&P, you know, is just in the last 6 weeks generated more return than an entire year of owning money market cash.
Yeah, it's been unbelievable. So March doesn't matter? I mean, is that the lesson of this week?
Yes, I think, I think the bond market really cares whether it's May or March. I think that the stock market really should just care that the Fed has gone from fighting inflation and almost giving the economy a heart attack to one where they're trying to manage the business cycle. So if they don't feel comfortable doing this cut in March and instead of May, I don't think it should have any effect on equities and how they do today.
The interesting part, I guess, is what you allude to. It's sort of this change in focus of the Fed, and I think Chair Powell alluded to this as much in the news conference when he cited, I think on multiple occasions, the strength of the labor market is not necessarily a bad thing anymore, so to speak. They don't feel perhaps as though they need to really lean on that to get inflation to come down because they've been surprised to the degree that it's already been coming down.
That's right. I mean, I think the biggest evidence this week was that ECI, the Employment Cost Index, you know, that number came in very tame, and Fed Chair Powell barely mentioned the labor market in the last press conference. I think it's because the job market is still adding jobs. I mean, today was a big surprise, but the unemployment rate's not really falling precipitously, and it's not creating a lot of wage pressure. So so far, I think the labor market isn't going to be the source of the concern for the Fed.
Yeah. What about the broadening of the market? It's been slower than I think, than many, probably you as well, have expected. Why so?
I think that the broadening of the stock market requires equity inflows. I mean, we already know that for the entire month of January, retail investors were pulling money out of the stock market. Maybe they'll start to allocate in February, but the month that they did, which was December, we saw a spectacular move in the Russell 2000. Do I think retail investors are going to be taking money out of the stock market? And in fact, someone had showed me that margin debt now is down 20% from its highs. I mean, you know, if that's any signal to me, I think broadening is going to come really sharply, but it comes when retail begins to buy stocks.
I mean, I'm thinking to myself, though, why get inflows now? We really get inflows? I mean, I don't know. The next stop on the S&P 500 feels like it's 5,000. Tom, the time for inflows seems like it's past, and now maybe people are going to be reticent to move money out of, you know, money markets and whatever else into equities at these levels, no?
Yeah, Scott, I mean, it's of course, the risk reward was better in October, but nobody wanted to own stocks October 2022 or October 2023. But there's also a lot of research showing that buying stocks at new highs isn't a bad thing. I mean, look at NVIDIA, right? If someone would have sniffed at buying it at the new highs, then of course it's up another 40%. I do think you are correct that 5,000 as an important round number is a level we have to watch. I mean, if this is a strong market, 5,000 won't mean anything. But in February, 5,000 could be, you know, a short-term top before there's a big air pocket. I mean, it's a level to watch.
Yeah, remind us of what your targets are.
Our year end for S&P is 5,200, but given how strong January was and what it implies historically, because usually the full year plays out in the first month, you know, I think 5,200 is probably a little low. You know, it could be, yeah, much higher.
So you don't think the market's too expensive here, as some are suggesting?
You know, expensive is in the eye of the beholder. Excluding FANG, it's your investors are paying 15 times 2025 earnings. I don't think that's very demanding. So I feel comfortable buying the S&P and even small caps here. Small caps, as you know, haven't really participated, but they're hugely leveraged to Fed cuts and very, very sensitive to investor inflows. And so I think there's still a lot of juice in a lot of areas.
Do you stick into your 50+% return on small caps for this year?
Yes, I think that's a reasonable target. What we have to keep in mind is small caps on a price to book basis are trading at 44% of the S&P's price to book. That's the only time you ever saw that was 1999. That was the low, a 40-year low, and it started a 12-year launch point for outperformance. So I think the risk reward is very good for small caps.
At what point do you get concerned about the mega caps, which you've suggested from the outset are the place to be? You've obviously been 1,000% correct, but at what point do you say, okay, well, maybe this is a little much?
Well, it's going to be a judgment call because, if someone asks me, do you want to own these for 5 years because they have structural moats? I mean, absolutely. So I think how much of that 5 years gets priced in this year, I just don't know. It's possible that the FANGs could have a great year in 2024 and then, consolidate for 2 years. I mean, that happened with Amazon, right? It consolidated for a few years and now it's really starting to break out. I think investors just need to buy those and really hold on to them. But I think there's still a lot of areas that haven't participated that could really start to outperform.
Like what? Give me something.
Well, for instance, I think when the Fed starts cutting, investors are going to change their calculus around financials and real estate because one of the biggest risks for commercial real estate is the risk of refinancing. Well, if the Fed's turning dovish, it's going to be easier to get investors willing to refinance these properties. That's really good for the banks and the regional banks, and of course, that's going to flow into small caps. So I think that the moment the Fed actually starts cutting, even though it's going to be widely anticipated, could be a really important point for some sectors.
Wow.